It is the 17th of May 2021. My name is David Hickson, and in today's market update I'm going to be discussing the process by which we confirm that troughs have formed in the markets. Before we do that, I must ask you to please make sure that you have read and understood these disclaimers. In today's update video, I'm going to be looking at the price action of the NASDAQ. In last week's video, I presented several different stock markets, starting with the S&P 500, and I did point out in last week's video that the analysis in the NASDAQ is very nice and clear, and so it makes for a very good example for this particular discussion. Now, in last week's video, I mentioned the fact that the 80-day cycle trough was due. It was running short in most stock markets that we looked at. And I also discussed, and let me just zoom in here for a moment, also discussed the possibility last week that the trough that had formed the week before was a potential candidate for the 80-day cycle trough. And I made reference to the recent wavelength when we took a look at the analyses of different stock markets, and was discussing the possibility that the 80-day cycle trough had formed. At some point in last week's video, I mentioned that Sentient Trader had not yet, of course, confirmed the 80-day cycle trough. And so when price turned down this week behind us, and I'm recording this video on the 17th of May, but I'm working with data up until the close of trading on the 14th of May, was it? That was Friday. And because I'm recording this video before the US markets open, and so we're looking at data up to and including Friday's price action. And so I spoke about the fact that we were expecting an 80-day cycle trough. There was a possible trough that had formed in the markets, but I mentioned that that trough was not yet confirmed. And there were several comments about how do you confirm a trough, and how do you know when a trough has actually formed, and so forth. And so that is going to be the subject of today's video. Before we speak about confirming the trough, I'd just like to do one quick thing here, and that is to zoom back out again and discuss very, very briefly the bigger picture, which is that, of course, we are expecting the 80-day cycle trough to form round about now. We're going to be discussing how we will know, or how we will confirm that it has formed. And after that 80-day cycle trough, we will be in the final 80-day cycle of the current 18-month cycle, which is expected to form a trough a little after the middle of this year. And so this is exactly the same situation as we are looking at in the S&P 500. There's no new information in there, but I thought it would be useful just to remind us all of what we are looking at. And I had several requests after last week's video to display the composite model line for the NASDAQ. And so there is the composite model line for the NASDAQ. Let me turn off the semicircles for a moment and we can concentrate on it. The composite model line, of course, includes information about the analysis that has been found in the chart. That's a very important thing that you always need to bear in mind. It's showing us the results, or the implications, if you like, of the analysis at the foot of the chart. And it is working with the data that we have for those cycles. So although it presents a projection into the future, you have to bear in mind that it is working with data that it has. It doesn't have a crystal ball. Sentient Trader is not really looking into the future. It is simply saying that with the information that it has at the moment about these cycles, this is what is expected to happen. And so you can see that we are expecting price to bounce out of the 80-day cycle trough. It is expected to form a peak, as a matter of interest, an early peak, because of course we have the bearish pressure of several cycles. So we are expecting an early 80-day cycle peak, and then price is going to come down into the 18-month cycle trough. Now, as you can see, the drop down into the 18-month cycle trough is not looking very impressive. But the reason for that is because there is no evidence in the data that we have that there is really any bearish pressure building up yet in this market. It's important to remember that price may well move down a lot further than is indicated by the composite model line, because the bearishness in the market might only appear quite late as we move into that 18-month cycle trough. It's a very important thing to remember and to bear in mind as we move towards that 18-month cycle trough. So let's speak about the confirmation of a trough and how we do it using Hurst cycles. Of course, our analysis tells us to expect an 80-day cycle trough forming at the moment in the market. And a week ago, we had that same expectation, and we had the possibility that an 80-day cycle trough had formed last week. This week, we are presented with another possibility for the 80-day cycle trough. So how do we actually confirm that a trough has formed? And then, of course, how do we make trading decisions on the basis of that? Now, making trading decisions is going to have to be the subject of many other videos, but the first step towards making a trading decision would be to confirm that a particular trough has formed. And that is what we're going to be focusing on today. So the first thing that we do when we are considering whether a trough has formed is we take a look at the number of bars that have elapsed since the most recent trough of that particular cycle. In this case, as you can see, there have been 70 days or 70 bars. And as the trough formed on Thursday, that was at a count of 69 days. And so our average wavelength of the 80-day cycle, you should know, is 68 days. That is the average length. In fact, I think it's 68.2 days, something like that. That's the average length that Hurst discovered 50 years ago. That's the extraordinary thing about these Hurst cycles. According to the research that Hurst did 50 years ago, there is a cycle that has an average wavelength of 68.2 days that beats in the markets. So the first thing we do is we say, well, that's pretty close to our average length. Now, of course, the cycles are dynamic. Because of the principle of variation, the cycle wavelengths are always varying. Sometimes we will see a trough forming at exactly 68.2 days, which is what might have happened here, but that is certainly not always the case. And at the bottom right-hand side of the chart, we have another piece of information, which is the recent wavelength. That is, in fact, the average of the past 6 waves of the 80-day cycle. And you can see the past 6 waves have averaged 56 days. So you can see that the 80-day cycle has recently in the NASDAQ been running fairly short. And so we consider these 3 pieces of information. The first is the recent wavelength of the cycle. The second is the average length of the cycle over many, many, many years. And the third piece of information is how many days have elapsed, in this case 69. There's an interesting thing about achieving an average wavelength. And there are 2 theories about the way in which we should handle this information. You can see that the recent wavelength of the 80-day cycle has been 56 days. Some people take the approach that because the recent wavelength has been 56 days, that means we expect it to continue beating at a wavelength of 56 days, or at least at a shorter than average wavelength. The problem with that, of course, is that if a cycle continues to keep beating at a much shorter than average wavelength, then our average length is going to decrease. And as I've just mentioned, the average wavelength of the cycle over many, many years achieves a length of 68 days. And so the alternative approach is to say, well, if it has been beating shorter recently, then at some point it's going to have to start beating longer in order to eventually get back to that same average. And so the fact that the recent average wavelength has been 56 days does not necessarily mean that the next wave is going to be 56 days. What do we expect? Well, as I've mentioned, in a bullish market, the cycles tend to form troughs early, which means that we tend to see a compression of the wavelengths, in other words, shorter wavelengths, which is why we are probably seeing this 56 days recently. But as we are approaching an 18-month cycle trough, we might expect to see the waves begin to expand a little. I hope that you're beginning to get an idea of how a Hurst cycles analysis is more of an art than a science, as Hurst himself said. We need to consider these pieces of information in terms of figuring out when this cycle trough is going to occur. Now, in my opinion, it is impossible to say with absolute 100% certainty that a trough is going to occur on a particular day. I know there are some people who like to do that. I'm not one of them. I take the approach that we have an expectation for when a trough is likely to form, and then we wait for a confirmation. So how do we confirm that a trough has formed? Using a Hurst cycles approach, we can use our cycle tools, the VTL and the FLD. So let's take a look at the VTL first. The VTL is a very powerful tool for confirming that a trough or a peak has formed in the markets. This is a downward pointing VTL, and when price crosses this VTL in an upward direction, it would provide us with confirmation that a trough 1 degree longer than the cycle upon which this VTL is based has formed in the markets. This is the 10-day VTL, and so therefore if price crosses above the 10-day VTL, we would have confirmation that the trough of 20-day magnitude is confirmed in the market. But now we're considering the possibility that an 80-day cycle trough has formed. So we would need price to cross above a 40-day VTL. Where is that 40-day VTL? There is the 40-day VTL. And immediately we see a problem with the VTL, which is that in this case there is an upward pointing VTL, which confirmed that an 80-day cycle peak had formed in the market when price crossed below it. We do not have a downward pointing VTL, and that is because of the rules that define the creation of the VTL. So in the absence of a 40-day VTL, what can we do? Well, we can turn to our other tool, the FLD. Now, the rule with the FLD is that when price crosses the FLD upon which the cycle is based, that confirms that a trough of that cycle has formed in the market. And so we are waiting for a trough of the 80-day cycle. That's the cycle that we are expecting. And that confirmation will only be provided by the FLD when price crosses the 80-day cycle FLD. This line that I am displaying on the chart now is that 80-day cycle FLD. As you can see, we are going to receive a confirmation that the 80-day cycle trough has formed very late in terms of the move upwards. In fact, in mathematical terms, we would receive the confirmation that the trough had formed roughly halfway through the move. So that doesn't look very encouraging. Do we have to sit here and wait until price crosses the 80-day FLD? Well, this is where the principle of synchronicity comes into play. One of Hurst's principles is the principle of synchronicity, and that states that cycles form troughs synchronously. In other words, they form troughs at the same time. How does that help us? It helps us in this case because we know that when a trough of the 80-day cycle forms in the markets, that must, by the principle of synchronicity, also be a trough of the 40-day cycle. So how will we get confirmation that the 40-day cycle has formed a trough in the market? The answer, I'm sure you have guessed, is that we simply take a look at the 40-day FLD. Now, if price crosses above the 40-day FLD, then we will have confirmation that the 40-day cycle trough has formed in the markets. And here's a really important point. We need to ask ourselves, if we have confirmation that a 40-day cycle trough has formed in the markets, does that confirm that the 80-day cycle trough has also formed? And that is why we constantly keep in mind the number of bars that have elapsed. In this case, 70 days have elapsed since the most recent 20-week cycle trough, which was also an 80-day cycle trough and, of course, a 40-day cycle trough. How many days have elapsed since the most recent 40-day cycle? Because within 70 days, there must already have been at least one 40-day cycle trough. And this is where we encounter a little bit of a problem with this analysis, because we take a look at the position of the 40-day cycle trough, and you can see that it is marked as being over here in this analysis. And so the next thing we ask ourselves is, are we confident that the most recent trough of the 40-day cycle has been correctly positioned? And that has been a problem recently in these analyses. That positioning this 40-day cycle trough, as I've mentioned in a couple of the previous market updates, has been tricky. So it does present us with a bit of a problem. However, you can see from this bar count over here that there have been 39 days since the possible recent 40-day cycle trough. And so, in my opinion, if we get confirmation that a 40-day cycle trough has formed in the markets, there is no question that this is possibly the first 40-day cycle that has formed a trough. It must really be the second one, and therefore that is enough evidence, in my opinion, to confirm that an 80-day cycle trough has formed. However, some of you are looking at this 40-day FLD and you're saying, wow, price has got to go really far to confirm that that 40-day cycle trough has formed. And so we have the same problem. We're waiting too long for confirmation. So what do we do? The answer, I'm sure you know, is that we step down to the next longer cycle, which in this case is the 20-day cycle. Here is the 20-day cycle FLD, and the same thing applies. When price crosses this 20-day cycle FLD, we will have confirmation that a 20-day cycle trough has formed in the markets. And so again, we ask ourselves, if a 20-day cycle trough has formed in the markets, is that good enough evidence that a 40-day cycle and therefore an 80-day cycle trough has also formed? And so again, we take a look at the number of bars that have elapsed, and we take a look at the strength, if you like, of the most recent 20-day cycle trough according to this analysis. Now, in my opinion, at the 20-day cycle level, this analysis is a little more convincing than at the 40-day cycle level, because the 40-day cycle trough was a little questionable. The 20-day cycle trough being positioned over here on the, was that the 21st of April, I think, that looks a little more convincing. And as you can see, there have been 23 days since that cycle trough, and the average length of a 20-day cycle is 17 days. And so you can see how the 20-day cycle has potentially been stretching and growing a little longer. And so in my opinion, if price crosses the 20-day FLD and therefore confirms that this is a trough of 20-day magnitude, that will mean it is also a trough of 40-day magnitude and 80-day and so forth. But now for some of you, that 20-day cycle FLD might still be too far away from price. So what could we do? Well, as you might have guessed by now, we can extend this process down to shorter and shorter cycles. We can look at the 10-day cycle and we can look at the 5-day cycle. The same reasoning applies. When price crosses the FLD of the 10-day cycle, that would confirm that the 10-day cycle has formed a trough in the markets. Does that give us confidence that the 80-day cycle trough has also formed by the principle of synchronicity? Well, again, that depends on the number of bars that have elapsed, and it depends on your confidence in the analysis at the 10-day cycle level. What about the fact that it looks as if though price crossed the 5-day FLD on Friday? That confirms that this trough is probably of 5-day magnitude. And by the principle of synchronicity, it was possibly also 10-day, 20-day, 40-day, and 80-day. Are we confident in that? Well, this is again where Hurst cycles becomes more of an art than a science. Every analysis is different. Every trough is different. Every situation is different. And also every analyst and trader is different. In order to really illustrate this idea, I'm going to extend into the intraday realm. Now, that is something that I don't often do in these market update videos, but it provides a very clear illustration of the point that I'm trying to make. So let's step down to shorter and shorter cycles. We will take a look at the 4-hour chart. Here is the 4-hour chart, and here you can see the nest of lows for the 4-hour chart for the 80-day cycle. And here we can see the FLDs for the 10-day and for the 5-day cycles. Now on the 4-hour chart, we can also add the FLD for the 2-day cycle. There it is there, that dark red cycle. And that 2-day cycle FLD, and let me clear the others, that 2-day cycle FLD was very clearly crossed early on Friday morning. Now that confirms that the 2-day cycle has definitely formed a trough in the markets. And so we can say with some confidence that the low point on the 13th of May was definitely a trough of the 2-day cycle. By the principle of synchronicity, that means it was also a trough of the 5-day cycle. Well, was it? That depends on your confidence at the level of the 2-day cycle. Let's continue this example and take a look at the hourly chart. There is the 5-day FLD on the hourly chart, and there is the 2-day FLD. Now, do you notice something interesting? The analysis at the foot of the chart on the hourly chart presents an 80-day cycle trough as having formed over here. Why is that? It's because Sentient Trader is following exactly the same deductive process that I've been taking you through, and it is considering whether the fact that price crossed each one of these FLDs is enough confirmation that the 80-day cycle trough has formed. At some point, Sentient Trader, like every Hurst cycles analyst, has to make a decision. They have to say, yes, that is confirmation enough for me. And that is exactly what Sentient Trader has done. So on the 1-hour chart, it is saying I have enough confirmation that the 80-day cycle trough has formed. That's wonderful. However, there is a danger here. And let's take a look at a shorter time frame chart. We'll drop down to the 15-minute chart. Here on the 15-minute chart, we have a 5-hour FLD. We could even display an even shorter FLD. And you can see that the 80-day cycle trough has not only been found in the analysis, it is also a filled-in diamond. It's a solid diamond, which means that at this level, Sentient Trader is confident in the fact that the 80-day cycle trough has formed. However, I should point out that at the 15-minute level, Sentient Trader is looking at the way in which price has crossed above and below the 5-hour cycle FLD. And in order to illustrate my point, let's drop to an even shorter time frame chart. Here is the 5-minute chart, and let's zoom back a little bit so that we can include our 80-day cycle trough. Here you can see the same 5-hour cycle FLD, but we have a lot more cycles down here at the foot of the chart. And if I zoom back in again to the most recent action, we can display perhaps the 1-hour cycle FLD. If you were watching the 1-hour cycle FLD at the time at which the 80-day cycle trough formed, and when price crossed up above that 1-hour cycle FLD, you had confirmation that a 1-hour cycle trough had formed. By the principle of synchronicity, at that particular time, and let's zoom back out even though we won't see the 60-day FLD at that point, let's assume that the 1-hour cycle FLD was crossed somewhere round about here. At that time, you would have had confirmation that the 1-hour cycle trough had formed. Did you have enough confidence in this analysis at that point to say that the 3-hour cycle, the 5-hour cycle, the 1-day, 2-day, 5-day, 10-day, 20-day, 40-day, and 80-day cycle troughs had also formed? Chances are you didn't. I certainly would not have, and I am sure that Sentient Trader didn't either. To really drive this point home, let's take a look at a 1-minute chart. Here is a 1-minute chart of that same 80-day cycle trough. A few points to make here. Why do we not see an 80-day cycle diamond underneath this part of the chart? The reason for that is because on a 1-minute chart you would have a stack of diamonds that would probably fill up so much of your chart that you can't really even see the price action. And so it simply truncates the stack of diamonds that is displaying the foot of the chart. It's also not showing any of the shorter cycles at this point because of the fact that it is limiting the number of waves back that it is using for the analysis. That's a little technical, I won't dwell on that now. But the point here is that the shortest cycle that we have in our chart is a 7-minute cycle. So if we were looking at a 7-minute cycle FLD, that FLD would have been crossed somewhere round about over here. And I ask you, at that point, would you have been confident that the 80-day cycle trough was therefore confirmed in the market? The answer is clearly no. The point that I'm trying to make is that the principle of synchronicity is very useful to confirm that a trough has formed earlier than the point at which the price crosses the FLD in question. The same thing applies to VTLs, and we could have done the same exercise by taking a look at shorter cycle VTLs. But let me just go back to our daily chart to make a final conclusive statement here. And so in conclusion, the confirmation that a particular cycle trough has formed in the markets is not a very simple process. It's not black and white. It's a fairly subtle process that I hope explains a little more about the art of taking a Hurst cycles approach to performing an analysis of the markets. I do hope that you found this market update interesting and useful. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.